While borrowing seems less relevant at younger stages in life, you might find that as you grow older, certain financial goals will be difficult to attain without it. Your first exposure to borrowing will most likely be with a credit card, which is considered short-term borrowing, or student loans, which are considered long-term borrowing. By managing your credit responsibly, through on-time payments, you begin to establish credit history. As your credit history is built, you make available to yourself longer-term borrowing opportunities. Some of the common ones you may have heard of are mortgages and car loans. When it comes time for you to take out a loan, you will go to a lender. That lender will make decisions on whether or not to grant loans, as well as the interest rates that they will charge you. Loan approval and interest rate are based on three specific areas of a loan applicant's financial situation. They are often referred to as the 3 C's. The first of the 3 C's is credit, which in some cases is called character. Your credit consists of previous loans and how you paid them, and it is used as an indicator as how you will repay future loans. All of your credit history is consolidated into a credit report, and from that credit report, a credit score is derived. With a number representing your credit score, a lender can quickly assess your credit history. In the case of credit scores, the higher the number, the better the history, and thus the more likely an applicant is to receive a loan at a favorable interest rate. There are multiple credit scores that are produced by various credit agencies, the most common of which is FICO. The second C is capacity. Capacity is a measure of whether or not you're able to take on more debt as well as manage payments on previous debt. The lender uses capacity to make sure that an applicant would be able to pay back a loan if they were approved. To see what ability you have to pay back your debt, a lender will look at your current income, the length of time on your current job, and your current expenses, including other loans. The relationship between your income and current expenses is referred to as your debt-to-income ratio by lenders. Lenders also may look at how much you are borrowing compared to your limits. Regularly borrowing more than 50% of your limit is often a warning flag for lenders. If a lender finds that the applicant's debt ratios are too high, then it hurts the chances of the applicant receiving the loan. Capacity also has some effect on your credit score. The final C is collateral, which is anything of value that can be used to secure the loan. Collateral can also affect if a loan is approved, how much is being loaned, and the interest rate of the loan. Some examples of collateral would be the houses in case of a mortgage, the vehicle if it were a car loan, and also the money in an account you create with the bank for a secured credit card. Having collateral can increase an applicant's chances of receiving a loan, and they can also decrease your interest rate. From a lender's perspective, they see collateral as a way to insure their loan. If you stop paying your loan, the lender may take the collateral as payment. Collateral is common for large loans and loans that the lender considers as being a risky loan. However, it is not present in all loans. If the loan does not have collateral involved, it is referred to as an unsecured loan and usually has a higher interest rate. Collateral is specific to the loan being given, so it is not in your credit score. In review, borrowing is both a short and long-term form of establishing good credit history, if managed responsibly. When applying for a loan, you will meet with the lender who will look mainly at the three aspects of your financial situation known as the 3 C's. The first is credit, which is summarized by a credit score. The second is capacity, which is measured by a debt-to-income ratio. And the last is collateral, which is the value of an object or account that the lender uses to secure a loan.